Good evening. This is Doc Severson for the Theonite Report for Tuesday, December 27th. So, all it seems like anybody wants to talk about in the stock media these days is Dow 20,000. And while the Dow is not exactly something that most professional traders watch all the time, this is somewhat of a poster child for the post-Trump rally. The Dow has put on about 2,000 points since the election, and right now is a little bit extended, certainly. But there's a lot of people out there that are calling for the death of the Dow. Whoa, wait until we just roll over into January. This thing is going to be sitting down there at Dow 10,000 or lower. Well, frankly, a lot of that emotion comes from people that have missed the move and are just looking for some type of revenge trade. So how can we look at this chart with an objective eye and understand the probabilities of what might occur as we get into the first few months of 2017? Well, like everything else, I like to do things from a top-down perspective, and I'm going to just look at price here. I'm just going to ignore this moving average on here. It doesn't really add anything to it. And what I'm going to look for is what I call the fractal energy indicator, which is also known as the choppiness index, and it's showing me the linearity of the recent trend. Being that a linear trend will expend a lot of energy and can't sustain in that direction for very long before it has to run into some type of counter trend behavior, whether or not that's to the downside or to the upside. Range expansion like this leads to range contraction, and then it just keeps on repeating. So a lot of times we can understand the probabilities for something just by looking in the past and seeing that as we've had these extended moves to the upside that bring in what I call technical exhaustion levels on this chart, you can see that right around this 30 level, this is where they usually kick into play. And so what we have to watch out for is areas where we have exhaustion all the way down here. Now, after this parabolic run in 2007, this is where we started to have problems. Now, a couple of things to keep in mind here. Tops are a process. Tops are a process. They take months to work out a top, right? It takes months to work out a top, even if that top is not a longer term top, just an intermediate top here. So we're staying in the monthly chart here. We're not yet at a level of exhaustion. I would expect this to kick in the next couple of months or so, and then we may have something interesting to talk about. But right now, I don't expect to see anything happening just yet. Now, what would have to happen next is we'd have to see this transfer into a very volatile area. You can see that these tops can get to be very, very volatile with a large range of the price movement, at least 1,000 points on the Dow. And once we establish that range, once we do go into exhaustion and then the Dow starts to work into that range, one of two things can happen. Either this range will break out to the upside and the former trend will resume from there, or we could see from this range the price actually breaking to the downside from this range, similar to what happened here in 2007. So this is the longer term view on the monthly chart here, showing that we're quite a ways away from anything serious likely happening here. Again, markets don't just drop from the top. Tops are a long extended process before they drop. And we're still not even in that mode just yet. Now, it probably a month or two before we get into that place, and then things are going to get to be more interesting. Now, in the meantime, what we also have is the weekly chart over here, having its own set of issues, its own set of patterns, right? So we can also see exhaustion down here, which is going to show up maybe 25 to 30 or so. And when we see something like that happening, typically we have a few weeks of sideways price action. Now, these are going to be smaller than the 1,000-point moves that we have up here at monthly exhaustion, but still nonetheless interesting. Looks like these ones are about maybe 500 points on the Dow. Okay, so you can see some of these moves that we've had as we've run into exhaustion and creating these nice patterns here. Okay, this one was an exhaustion move to the downside eventually after it hit consolidation up here. So the point here is that we get patterns within patterns. And right now we do have an exhaustion signal. This is why I'm seeing that even if the price does inch above 20,000, in the near term, and hopefully it happens soon so we can just get this over with, what I would expect to see at that point is a consolidation pattern setting up on the weekly chart. Now, this is going to be nothing more than noise on the monthly chart, but a decent consolidation level on the weekly chart. So perhaps as we get into the January timeframe, this is what we can look forward to. Okay, and we're seeing this on the daily chart right now. As we get into daily chart exhaustion down here, this is where we're running into these consolidation patterns. So range expansion leads to range contraction, which leads to range expansion again. And the more exhausted that we get on these larger time frame patterns, the less of a breakout that we're going to be able to sustain without that breakout being pulled right back down again into the mud. So, in summary, for those calling for the death of the Dow in the short term, I don't think that's going to be happening. I think what will happen first is that we'll get into a large range, first of all from the weekly chart, and then ultimately expanding into the monthly chart. So this could be, as we get into the first third of 2017, a very volatile range and something similar to what we saw here at the beginning of 2015. So this is how we can use different time frames on charts to build a better probability analysis in terms of how we can trade that particular chart and secure some edge. That's it for today's report. Thanks for listening, folks. Have a great week. See you tomorrow.